All right, market commentary. Here I go. So some economic data came out. Four numbers came out at 7:30. It took a little bit of delay for them to come out entirely. One was initial jobless claims came in at 5,000 lower than expected, 745,000. Continuing claims came in at about 4.3 million. There was no real good estimate, but what it looks like is that that is down by about 200,000. The most important data that came out so far with regards to economic numbers was definitely unit labor costs as well as productivity gains. So productivity gains in the economy came in at a negative 4.2%. Now that came in a 0.5% better than expected. So many of you might be wondering, well, what does that mean? Unit labor productivity. That means that when you and maybe we need to look at unit labor productivity with unit labor costs, because this is an incredibly important metric to look at when you're assessing what a company is worth and what its cost structure looks like. And if you're in business, you can relate to this a little bit more. So let's assume, for example, you are a retailer. Okay, so right now, minimum wage increases across the country. You happen to be in retail, your retail labor costs went up by, say, $1 an hour. So now if your cost structure was 20%, so for every every $100,000 worth of stuff you sold, you had to pay 20,000 out to labor. So now if your labor cost goes up by 6%, 6% of 20,000 is $1,200. So so if your unit labor cost goes up by 6%, it's 6% times 20,000 is $1,200. Usually it's easier if we'll just use the example of 5% because you can cut 20,000 into 20 times. So 5% increase would have been 1,000. So in this case, it was 20% more than that because 6 is 20% more than 5. So you're talking about $1,200 increase in your labor costs. Now, if you don't, if you just want to stay even, you didn't even make any more money. You just want to what? I'm not trying to make more money off of my labor. I just want to cover my costs. So just to cover your labor cost increases, you would have to raise prices by about 1.2%. All things equal. This is assuming nothing else in your cost structure went up. So your insurance costs didn't go up, and keep in mind that every insurance company had their labor costs go up. The cost of your goods being shipped to your store, that didn't go up either, right? All those minimum, all the wages across the economy, it kind of ripples through. When you increase minimum wage, it ripples through to the other wages. So you can see this effect magnifies itself, so that your overall cost structure, if your cost at the pump, your cost of distribution to your store or delivery charges, your insurance rates, your electricity rates, everything flows through when minimum wage increases hit the economy. Okay, so those increases were 6% across all 150 million workers. This number is not about minimum wage. Unit labor costs, I'm just using that as an example. Unit labor costs across the entire U.S. economy rose by 6% in one quarter. Okay, and these numbers are always annualized, just so you know. So this isn't. It's important to know that they kind of look at them in an annualized basis. Okay, so now the productivity gain, when you have your cost structure go up by 6, the productivity gain was negative 4.2. So what that's basically saying is, if you didn't want to see, the better way to think of that productivity number, it went down by 4.2%. So companies across the economy were able to absorb some of the wage increases that occurred by about 1.8%. That's what that's basically saying. If wages went up by 6, productivity loss was 4.2. They picked up the difference, because if they could not pick up any productivity gains, then it would have been a negative 6. It would have literally offset the unit labor costs. if you have no ability to get better with how you use and schedule your time and how efficiently you use your workforce, it would have been -6, and the cost would have been +6. Now, granted, there's a couple of little mathematical differences when you go positive versus negative, but we don't need to get into that specifically. So the fact that it went down by, productivity went down by 4.2%, that means there was some productivity that was able to be had to absorb this type of a jump with regards to the unit labor cost. Okay, so that's that. It's extremely significant, and when I say it went up by 1.2%, just to give you some perspective, Walmart, the largest retailer in I guess the largest physical retailer, I guess you can say Amazon might. I think it's definitely catching up if they're not neck and neck. Amazon's profit margin is probably 2.7 to 3%. So a 1.2% increase in your labor cost could theoretically knock out, if Walmart couldn't pass along this cost increase to its structure, which it could because it's a very big player, it would have had to take a hit by the tune of 40% of its earnings. Now, Walmart sets the pace for the entire retail industry with regards to physical locations, so I'm sure they were able to pass it through just fine, and I don't think their margins are going to come down. But now for smaller businesses across this economy, it's not always an easy thing to do, and that's why when you see these types of jumps, it's very disturbing to see them occur in such a short period of time, because some of these smaller companies don't have the resources or the I guess the tools, know-how to absorb these things in a manner that doesn't disrupt the relationship they have with their customers. So that's why the entrepreneurs in this country that are smaller and don't have thousands of locations, they tend to have a more difficult time in an inflationary environment than some of these mega corporations that are around the world. Another thing came out today, which is disturbing. As everybody knows, oil prices are up over about 25%, 25% since November of last year. The economy is starting to open up, and there's 2 more states that were added. Texas, it's Texas, Mississippi, and I think Iowa, and I forgot the other one. Maybe it was Montana. Iowa and Montana are now open for business. Okay, so 4 states are fully open, maskless, open for business. And while this is happening, the reason why I say this is, I think Biden is responsible for some of this, is he's a pro energy outside of the U.S. type of guy, and OPEC, with in particular Saudi Arabia, while the economies are starting to open up across the states are opening up in the U.S. and then other countries are opening up with this China virus, they decided that they're going to cut oil production. So not only they just saw a 20% plus increase in the price of oil, and now all of a sudden demand is coming back online, and now they want to cut supply. So if you cut supply and demand is rising, you do have a lot of price pressure. So that's something that's extremely aggravating. The United States has over $100 trillion of oil on federal lands, oil and minerals, believe it or not. We, the people, control that $100 trillion. I think at some point we should create a sovereign wealth fund for the United States for the benefit of the people, and make sure that these resources are not stolen from us, not any differently than the families in Saudi Arabia stole the oil from all the people that live there. And I think this is one of the reasons why energy independence on U.S. soil, we can have it the moment we want it. But what's happening is they're trying to take control of the entire economy, and so that they can steal all those resources and keep them for themselves. So they're playing a different game than the average American. They're looking out 50, 100, 200 years, and they're thinking, how do we get all this oil and all these resources that are worth over $100 trillion on U.S. property, U.S. lands that are owned by the taxpayers of the United States, and let's just take it all for ourselves. And so we need to outsmart them on this. This is a really big deal. And it's going to be a bigger and bigger issue as time goes on. So somebody just asked a question here. I'll just answer real quick. What are your thoughts on 401k? 401k seems like a scam because they can take out and move to physical assets such as land. Yeah, I don't know about your particular 401k, but I do know that there's a lot of rules with regards to 401ks and laws that have to be followed. And if it's a company, they should have a third-party administrator. You have a right to request all that documentation so you can read it over. And if they're not giving you that documentation, then something's wrong, and you should probably look into what your rights are with regards to some of these agencies, like I think whether it be FINRA or something else. But most people aren't out to get their employees, so I think you should look into just ask them the question, hey, can I see my documentation? What are these assets going into? When I put money into my 401k, and I'd like to better understand what my investment options are. And it's a very heavily regulated thing, and so because it's so heavily regulated, you do have a lot of embedded protections in place, and maybe your company is not doing a good job of explaining it, but that doesn't necessarily mean they're trying to do something wrong. They just might not be explaining it as well as you'd like. So I hope that answer helps. Okay, well, with that, thank you everybody for joining in, and I will see you after the close and tell you how things wrapped up on the day. Futures were pretty much flat, so I didn't. If there's nothing going on in the futures, I'll just say they're kind of flattish. Flattish is like up or minus 0.25%, 1/3%. It's not significant. I can quickly take a quick look here to see if futures have changed as a result of that news being filtered through the markets. Sometimes there is a lag, so people are kind of making sense of what they think of it. And right now they're just flat. So it went from being down 20 bips to up 20 bips. So the market likes the news. Maybe the productivity number, as I was saying, being negative 4.2 versus negative 6 was a positive surprise. And I think it was, actually. I think it came in, it was 0.5% better than expected. So 0.5% is a really big deal over time in an economy. So that might be why, the futures went from negative 20 bips to positive 20 bips. So, okay. Thank you guys. Have a great day.